Welcome back to Startup Accounting 101. This is the video series for founders to understand accounting fundamentals for starting a business. Now we're continuing through a financial projections template, and this is available for free from score.org. Go to their template gallery and download this template. I'll put their link in the description below. Now, the next major section we're covering is sales forecasts, and that's section 3. We are starting with 2A, which is sales forecast for year 1. But before we get into the forecast, we have to first calculate the COGS. And the COGS is short for cost of goods sold. So this video will cover COGS per unit. Now, COGS per unit header has a hyperlink. So here it says tip, click here to access a calculator. So we'll click here. And you'll be taken to the COGS calculator. It's one of the tabs towards the end of the template. And we're calculating the COGS for products and services. So down here. Now, there are several ways or methodologies to calculate COGS. So I have written the 4 to 5 methods to be able to do that. And so here's an overview of the different COGS methods. The first one is LIFO, which is short for last in, first out. LIFO, L-I-F-O. And what that means is the last item that comes into inventory. So the last item that you purchase, that is what I'm selling. That's what goes out first. And companies like Costco, for example, will use LIFO. They have just-in-time inventory, really high inventory turnover, so that works for them. So the next one is FIFO, which is first in, first out. And this is used by most, food and beverage companies that have perishable goods that have an expiration date. Obviously, the first item that comes into inventory, that's the one you want to sell. That's one you want to use. And a lot of retailers like Walmart, for example, will use FIFO. Now, the next one is average cost, and that is basically all of the goods produced during a specific time frame. And this particular template uses average costing. So you see time frame here and here in the different cost calculations. And companies like CVS will use average costing. The next one's weighted average. It's a slight variation of average costing. So average costing is based on, this is how much I'm going to make or produce during a specific time frame. Weighted average takes, here are all the purchases I'm going to have over a particular time. And I'm going to take all of that and spread it out over the number of units I have on hand. Like, this is how much I have on hand. So it could be constantly adjusting. So if you're purchasing new raw materials, that the costing is just divided by the number of units that you have on hand. So you can have a daily, weekly, monthly adjustment. It will just keep getting weighted across the average of whatever's on hand. And a lot of different manufacturers, the gas and oil industry, that they use weighted average. Now, the last one is specific costing. If you're able to uniquely identify each item, so if there's like a unique serial number or like a VIN number, a customized order, you're able to use the costing, so the specific costing method. Now, we'll have a more in-depth breakdown of COGS in a later video. Just for now, just know that these are all valid COGS methods. You just have to choose the one that works the best for the company. The most important thing is once you choose the method, you have to stick with it. You can't just switch between the different methods whenever you want. In fact, any changes you make to the inventory cost method actually needs to be reported to the IRS. And so there's a form 3115 that you would send along with the first tax return when you make a change. So that informs the IRS you're going to change the methodology for whatever reason. There's all sorts of reasons. And so you'll submit that together with your tax filing. And again, just choose the one that works best for you, and you're going to stick with it. So now we're going to move back into COGS here, and starting with the products. So again, this is average costing. So it takes costs against a specific time frame. I'm going to use per month over 1 month. And a particular product line, I'm producing candy bars. So actually a sidebar on product lines, just a note about SKUs versus UPC. So a SKU is short for stock keeping unit. So when you're starting out, come up with a naming system for your products. It will help you with future product launches. And you, as the business owner, as the founder, you get to decide the name. You can call your product, your SKUs, whatever you want. It could be letters, numbers. Like, this is a way for you to keep track of your stuff. And so, and that is, versus UPC code. That is the barcode that you would print on the packaging. That is what's like scanned at the register. And this is standardized. This is always 12 digits, and it's issued by GS1. Now, so in the beginning, you're only going to have 1 or 2 products. It's easy to come up with a SKU. Make sure to have something that's scalable so that when you add different flavors of candy bars, you have a different way, a systematic way of creating a new SKU. Now, okay, so back to the actual COGS, the costing, and building the costing for the candy bars. And it's over the entire product line. Doesn't matter what flavor right now. When you become a little bit more advanced, you're going to want COGS per SKU. So every single candy bar, every flavor, you're going to want a SKU breakdown. Okay. And in order to do that, we will cover BOMs, which are bill of materials, and we'll cover that also in a later video. Now, for this template, for all the candy bars, you're going to add up all of the raw materials used for the candy bars. It doesn't matter which flavor, you just add them all up. And you're going to put together the purchase price, what you purchased them for, and you'll put it here. Now, for labor, to produce a product, if it's an artisanal candy bar, you're making it yourself, you're hiring somebody to make handmade delicious candy. Just, how many hours are spent making the candy. If you have to pay for shipping, freight delivery, storage in a warehouse, you're going to put those costs here. And then production facility expenses. If you are outsourcing, if you are going to be co-packing or co-manufacturing your products, then that would be here. If you need to rent a commercial kitchen to make your candy bars, you would put that here. So all of these expenses are added together to make the total product expenses. So over the entire month, like this is how much you're spending for all of the candy bars. And then the number of units produced. So you're with all of this, I'm able to make 25,000 candy bars. So that gets me a COGS per unit per candy bar. It cost me roughly 39 cents to produce one candy bar. Now, so that's for products. Now, if we move down to services, also known as the cost of revenue, a note about services: COGS are typically not part of the financial statements for service-based companies. It typically is only seen in products. So if you're producing anything, it would have in your income statement, in your financials, you will have a COGS section. For revenue, for services, it really is up to you whether to put it in there. For this exercise, like we'll do this exercise just to know how to properly price the services, to ensure that we have the right margins and make sure that we have our costs covered when trying to figure out how to price services. So the service that I chose to, for example, is a website redesign. So the time frame is per project, and it takes us about 1 month to produce and redesign a new website. So here you're going to want to put all of the labor that's needed to redesign a website. So you've got maybe a designer, a graphic designer, and a developer together working, full time. And then here would be any materials you'll need, whether it's stock images, hosting fees, and then next would be any other costs that are not covered above. Like these all will be the total service expenses to to redesign that website. And for me, because my time frame or the basis is per website redesign, for me, the number of units is 1. Now we've completed the calculations, the COGS for a product and a service. So we're going to click the hyperlink here to return back to the sales forecast. And the COGS that we just calculated, you would enter that here in this section. And so, yeah, now we've completed the COGS per unit. Like and comment if you found this video useful. Let me know if you have any questions, and subscribe to keep up with the next video of this template, where we actually now put together the year 1 sales forecast.